it on from whatever it takes, and the ECB is now being told that it must cut interest rates again and launch a fresh round of unconventional monetary support. That's according to the IMF, who have also claimed that the euro area recession is likely to last 2 years, returning to growth at an unspecified point in 2014. In the IMF's assessment of the 17-country Eurozone economy, the organisation praised the extended deadlines that EU finance ministers had provided to several countries to reduce their budget deficits, but suggested that the European Central Bank should act to help growth with measures to reduce financial market fragmentation within the region, i.e. to stem the north-south credit rate divide. The fund advised, taking its current approach forward, the ECB should ensure funding needs for weak but solvent banks through an additional LTRO of sufficient tenure, adding this would be most effective if accompanied by lower collateral haircuts, particularly on small and medium-sized enterprise loans. First quarter GDP data released earlier this month highlighted a quarter-on-quarter contraction of 0.3%. In their report, the IMF predicted that the Eurozone's GDP will contract 0.6% this year before expanding by 0.9% in 2014. But the ECB was not the only institution the IMF had advice for. The fund also urged the US Federal Reserve to continue monetary easing, claiming that tapering could reignite stress in the financial markets. The report states that early tapering by the Fed could lead to additional and unhelpful pro-cyclical increases in borrowing costs within the euro area. This could further complicate the conduct of monetary policy and potentially damage area-wide demand and growth. All eyes will now be on the Federal Reserve and ECB rate decisions taking place on Wednesday and Thursday of next week. The Dukascopy TV team will be keeping you updated on all of these events and more, so stay tuned.